Hi, I'm Markita Woods, mortgage advisor with Fairway Independent Mortgage. I'm a 23-year mortgage veteran, and today I want to talk about Own Your Future, Mastering Money for Life's Big Decisions. As you will notice, this presentation is being brought to you by First Home IQ. I am an ambassador with First Home IQ. First Home IQ is a nonprofit organization dedicated to financial literacy for our next generation and those that are looking to become homeowners for the very first time. So let's jump into it. When we think about money, it starts in the mind from a psychological standpoint. So, the psychology of money and what you need to do to be successful basically starts with a plan. It's very important to have a plan to achieve what you want in life. Let's see where you are on the money mindset continuum. Are you scared of money? You want to build wealth. Those are both ends of the spectrum. As a loan officer, I look at credit and people's finances on the daily basis. And I know that there is a need for financial literacy in our high schools, colleges, because many of us didn't have these conversations in our households when we were growing up. So take a look at this and think, where are you? But let me explain, how can your mindset and attitudes about money impact your long-term ability to build wealth? See, many of us didn't have a plan coming up. I made all the mistakes possible because money wasn't talked about in my household. So financial planning is very important. With that in mind, let's talk about some of your financial goals. What are some things you want to save for? How might creating a financial plan help you to reach those goals? I am a huge basketball fan, being that I'm a former WNBA player. And Rick Pitino has a saying, or well, I guess it's a quote. I don't know what you call it, but it was called the 5 Ps. And it says that proper planning prevents poor performance. So that can be taken away from basketball and used in any type of life scenario. Money's no different. So proper planning will prevent poor performance. So with that in mind, you have to come up with a spending plan. So understanding your income versus your expenses. If you're thinking about buying a home, one of the things that we look at is called the debt to income ratio. And basically, it's how much debt, expenses, i.e., versus how much income you have. And that helps us determine what your buying power could be. So, income is what you earn, obviously. Expenses are what you're putting out, stuff like rent, food, things like that. But it is crucial in planning to track both of these numbers. This was a huge downfall for me. I made in a lot of money, but I didn't know where the money was going. I was a person that was prone to do what was called impulse purchases. And as a result, at the end of the month, the numbers didn't add up. So, one of the planning rules that we've talked about with some financial planners that they have their clients put in place is called the 50, 30, and 20 rule. So 50% of your income goes to your needs, 30% goes to your wants, and 20% goes to your goals. Let's stop for a minute on that 20%. For me personally, I also had to learn to pay myself first. So when I got in my check now, the first 20% goes to me. That is my goals. That is my account for the things that I'm planning for or want to buy or pay for, such as travel. I love to travel, so one of my goals is to actually travel abroad, and I need to save for that. So that is 20% goes to me, and then I divvy up the other 80% between the 50% and 30%. It just depends on your household. For some, maybe it's more of a 60% needs and 20% wants, because sometimes we have to have what's called delayed gratification. But nonetheless, just understand that it's very important to have a plan. Another thing to plan for is emergencies. Just save it and leave it. So just fund can be there just for life surprises. I would say this is the foundation to start. Trying to save 3 to 6 months of living expenses for emergencies, and then starting to implement your plan for moving forward for those bigger goals. Now, I know we live in a high cost area, and that may be challenging to do to get the 6 months, but possibly we take on side jobs or we do anything that we actually can to build up that fund so we can start our proper planning and using money the right way to achieve our goals. Now, the name of this presentation is Own Your Future. So I started off with our foundational talk about money, but the other thing that we actually look at far as buying a home is credit. So it's very important that you understand credit and what that really means when purchasing a home. We look at 3 areas. I call it CIA, credit, income, and assets. So credit being the first one in that list, it is very important to know what your score is, to understand how it works, and be very vigilant about my having good credit. So a credit score basically shows how likely you are to repay debts. And of course, the higher the score, the better. That means that the lender, which would be us, or a bank, will be more willing to give you credit if you have a higher credit score. Okay? So let's think about this. The bank is lending millions of dollars, hundreds of thousands of dollars to help people purchase homes. I don't know about you all, but if my cousin just asked me to borrow $500, I kind of want to know how reliable they are going to be to pay it back, or am I just giving them a gift? Well, banks are no different, because think of the escalated level and amount of money that's actually being lent. Okay, so the role of the credit score, do you know yours? Kind of already talked about it. Um, we have a scoring model range anywhere from 300 to 850. The average credit score in America is teetering, in my opinion, around 680 to 700. So in the good range. So 300 to 629 is considered bad by many people. 630 to 689 is fair. 690 to 719 is good. And 720 and above is excellent. We do loans down to a 580 score, which actually would consider somewhat bad credit. I like to work with people to help them raise those scores up at least into the fair range, so that you have better interest rates on these thousands of dollars that you're looking to borrow. So here's some ways to actually build good credit. Um, it's repayment of the debts on time. Um, Having good credit actually affects so many different things these days. How much your rent is. Of course, we already know having good credit is buying a house. But even now, getting a job has something to do with looking at credit. And although it's not mentioned on this slide, did you know when you go to get insurance, now they're actually looking at credit? So building good credit by paying bills on time and not maxing out credit cards is a huge step towards making sure that you're getting the best rates and you're able to have all of the things open to you and not locked out because of your credit score. Now, a credit score is made up of a few different things. The first being the payment history. That's the largest piece of the credit scoring model. And if you notice, I said it already twice, paying on time helps you have good credit. I'll say it again, paying on time helps you have good credit. But the next piece of that is the amounts owed. So we talk about making sure not to max out any credit cards or different things that you actually have, because there is a thing called credit utilization. That is a huge part of the score outside of paying on time. So how do you utilize credit? Let me give you an example of how this actually works. Let's say that Capital One has given you a credit card for $1,000. That is your high credit limit. With that in mind, if you have used up to $900 on that credit card, you are a high risk because your credit utilization is at 90%. So $900 in use on $1,000 high credit limit looks like high risk to the lenders, and it does actually affect credit score. So I'm going to give you a hack on what you need to do to keep your utilization in order. So the other things are credit history, new credit, and then your overall credit mix, which is the last piece as far as how a credit score is actually made up. So here's 6 ways to build credit from zero. So if you don't have a credit score, the first thing you can do is apply for a beginner's credit card. What's a beginner's credit card, Markita? Well, I'm glad you asked. That will be like a secured credit card where you deposit your own funds and they give you a credit limit. So let's just say you were to deposit $300, you get a credit limit of $300, and then you would use that credit card just like any other card, and it will report to show how responsible you are about paying credit on time. So when I say responsible, don't use over 30% of whatever your credit limit is. So these cards are secured cards, but you also could get them unsecured, where again, it starts you off with a lower limit to see how you're going to actually use credit over time. So for numbers example, let's talk about it. If you had a credit card with a limit of $300, you don't want to go over 30% of that. So that means you never want to carry a balance of more than $90 on that card. So that is how you figure out what your maximum should be when you have a credit card in use. Of course, make payments on time. We keep saying it because it's just that important, but also keep your accounts open, right? So make sure you keep your accounts open. Don't close the account after having them, because remember on that one slide, 10% of your credit score is based on length of time. Now, this next one that I'm talking about is actually a hack. You know, we hear about all these little different hacks for life. Well, this is a credit hack. You can be added as an authorized user to a more established account that has a good credit history and has responsible use of credit, such as keeping that balance between 10 to 30%. I've done this for my teenage sons so that when they're 18, they will have a credit score by me adding them to my account as an authorized user. Now, I haven't given them the cards to use. They're just added onto my history. So this is a hack to help raise score very quickly or generate a score very quickly by piggybacking the established credit of another user. And the last thing that's listed here is monitor your credit regularly. Hey, that should be easy to do. There is no excuse today to not have an understanding of what's happening on this oh so important part of buying a home, of raising credit score, is monitoring it, because we have all kind of apps. When I started in this business back in, I won't even say, well, I said I was a 23-year veteran, so here it is. In 2002, I started in this business. People would come in to purchase a home and we would pull their credit and they had no idea what was there or what was going on. I've even had the situation where the wife didn't know that the husband had maxed out the card, or the husband didn't know that the wife had paid the car payment late, because there was nothing to let them know what was happening on the reporting. So these days you can monitor your credit with so many different apps, such as Credit Karma, Credit Sesame, Experian. There's so many apps now. Even I can't think of the name at the moment, but even if you bank, your bank also actually may offer some type of credit monitoring. Now, just know that this is a monitoring of credit so you can know what's happening, but this is not the credit score that's used for people looking to purchase a home. So use those apps to monitor and stay vigilant, especially in a time of so much digital how hacking into people's account and data being breached, is very important to monitor your credit at least on a monthly basis. Now, what are we doing all of this for? We're talking about the basis of money and having a plan. We're talking about how to build credit. We're talking about this because if you're looking to buy a home, some things to consider renting versus being a homeowner in the future. Let's jump into some of the benefits of both. So, what are the benefits of owning versus renting? Here's a couple things to consider. Young people, renting offers flexibility, minimal obligations for repairs, and easy locations. So, if you're not settled or don't think you'll be in the area, then it makes sense to actually rent. Gives you flexibility. You can up and go a lot easier than someone that owns a home. But ownership still has benefits as well. It does offer stability if you're looking for that. It has tax benefits and it gives you freedom. So when you're renting, if you love purple, you can't paint those walls purple in that other person's home or apartment. But if you own that home, you could go crazy with your purple accent walls, doors, and everything else, right? Now, the biggest thing that I love about the benefits of owning are listed here on this next slide. The equity building. So you say, Markita, what is equity? So equity is basically the gap between how much you would pay for a house and how much that house actually appreciates to over the long run. So you also can have tax benefits, which we know the IRS seems to tax us on everything. So to be able to have something to write off against those taxes is a great benefit to have of ownership. And then if you look at the long haul, and when I say long haul, I'm thinking anything 5 years or more, there's long-term savings for being an owner versus renting. In fact, the wealth gap between renters and homeowners right now is at a historic high in America. Prices have continued to gone up, which means that appreciation we talked about has gone up. And as a result, there's a gap between the average net worth of a homeowner versus an actual renter. So these are some things to consider when you're thinking of actually purchasing a home. So let's take a look at that. And I got this information from the Survey of Consumer Finances. If you look at the overall picture, just to break it down really easy, the net worth of a homeowner is about 4 times that of an actual renter. So some things to actually consider, right? So you say, okay, Marquita, you have me sold. I think I want to be a homeowner in the future, but it costs a lot to buy a home. I need a down payment. Maybe I didn't serve in the military, which has an option for a zero down payment loan. So I need money to invest in purchasing a home. How much money do I actually need? So, how much you need really depends on your specific scenario. So, it is true that you do need a down payment. There was a huge myth for a while, though, that 20% was the down payment needed to purchase a home. Can you imagine a $400,000 house? 20% of that is 80,000. You actually do not need a 20% down payment. You can buy a home with as little as 3% down payment if you didn't serve in the military, all the way down to zero down if you're willing to live in a rural area. So there's some ways though that you can offset some of that down payment if you are a first time buyer. Virginia has programs that will allow down payment assistance up to a certain income threshold. Everybody's specific scenario is different, so make sure you reach out and talk to a loan officer that can craft the right plan and get you some down payment assistance. So $400,000 sales price will be a $12,000 down payment at 3%. However, there is some grant money that can lower that actual cost. All right. So another thing that we want to talk about in the down payment, if you've made a decision to buy, you know there's their down payment assistance. Let's look at the overall big picture of renting versus buying and what your net worth could be in a 5-year period. So this is based on a $400,000 sales price with the average appreciation rate of 4%. Now, the appreciation rate is going to vary based on where you buy a home, but I think you get what I'm trying to convey here. So your net worth, remember that slide I showed you that the net worth of a renter is less than 4 times of that of someone that owns a home over the long haul. So when you're renting, you're not building what's called equity. And that is the difference between how much a house actually is valued for and what you actually owe. So on this graph, I'm showing you what it looks like for a FHA loan, which has a 3.5% down payment, and a conventional loan with a 3% down payment. What your net worth would be just by owning where you live, right? So 106,000 versus 105,000 over a 5-year period based on that appreciation. But let's just say you had to use some down payment assistance. It cuts into those numbers some, but as you can see, it's still 6 figures just by deciding to be a owner versus an actual renter in today's market. So these are some things that I wanted to share. I have a quiz that we can go through that you can learn what is your first home IQ score. So you can scan the QR code to take the quiz. It has some questions to see how far you away or what your understanding is. This was just a starting point, but I hope I've encouraged you to want to own your own future. So scan the code or type in the link that's listed below, and let's see what your score is, and we'll get you on the path to home ownership. Again, Markita Woods, First Home IQ Ambassador, signing out. Thank you so much for your time.